many other factors, it contributed to the sluggish growth in the European economy.
Actually, that's a topic that I wanted you to comment on, because following Tim's comment on the US, perhaps we should also take into account something we are going to, sorry again for selling the product, the bastard, but we are going to deal with in the masters, which is bank regulation, as Geoffrey said. Because also Trump's administration has said very clearly that they want to review bank regulation, they want to relax bank regulation in order to make especially small and medium banks easier to expand their deposits. And this may, obviously I don't have the certainty about it, but this may offset for that shrinking balance sheet policy of the Fed. What do you think?
Well, there's been over the last 30, 40 years, there have been a number of financial deregulations. And then from 2008, kind of re-regulation. What happened in Britain, for example, in the early 1970s, we had something called competition and credit control, a major easing of monetary policy. And by the way, Forrest Cappy, I think, will be hovering in the background for our course, and he's historian of the Bank of England, and so will give us some help on that, I trust. But what happened then was this easing of regulation, surge of monetary growth, and then in 74 and 75 also a surge in inflation. And it was indeed this particular experience that made Friedman, monetarism, quantity of money so important and relevant. We've now had this re-regulation since 2008, drop in money growth, very low inflation, indeed deflation, offset, as Geoffrey has said, by QE and in the Eurozone. And now, will there be a major deregulation by Trump beginning, say, late 2017? I don't really know yet, and we must watch again, the question of watching this space. What I would say is that, you know, my profession, our profession, the economists, that most of us don't look at money figures. So what you may well find, say, late 2017, 2018, early 2018, is you see bank credit expanding faster, money growth starting to take off in the United States. The US economy is not coming through this year because, you know, already at the moment money growth through a week. You may see everything changing quickly. And nobody picks up that there's inflation coming up in, say, 2019, 2020. It's terribly, terribly important to watch what's happening inside the banking system, because that is really the key to understanding the economy.
Well,
and I just finish on that, which is, you know, too much in economics. There's this dreadful textbook, Samuelson, go back 1940s, and then all the successors to Samuelson. They ignore, and they have a little chapter about money and banking. They miss the truth. Okay, there's a lot of nonsense in that textbook, a lot of misleading, puerile, uninteresting stuff about multipliers and so on. We're going to be teaching much more important stuff than that.
Yeah, may I say that Samuelson's is not the only one. He was followed by a myriad of textbooks.
Dozens of
him. Yeah. So, do you want to comment something?
A couple of words about regulation, actually. I'd like to take up Tim's point on competition and credit control, and how that led to a revival in money growth in Britain, and then to a revival of inflation and monetarism. But before I come to that, I think we need to think about why we have regulation of banks. The fashionable idea is that regulation is necessary to prevent bank failures. Let us compare that with a very interesting figure. British banking was entirely unregulated apart from normal commercial law until the Banking Act of 1979. There was no regulation of banks then whatsoever. Why weren't they going out and taking tremendous risks and ruining the economy? Because then banks either thought they could fail or actually did fail. And the nonsense also that banks can be too big to fail, I think it is a nonsense. We have evidence contrary to that. First of all, it doesn't matter whether they can fail or not. What matters is that the management thinks they can fail. There's a very famous episode where we can show that the management of big banks then thought they could fail. In 1932, the British Treasury wanted to carry out a major operation in British government securities, They wanted to be able to say that all the clearing banks supported them in this and had gone along with this operation. The chairman of Midland Bank, Reginald McKenna, who just happened to be a former Chancellor of the Exchequer and thus had acquired a low and suspicious nature, realised that this was not good for his bank. It might, he thought, put it at risk. So he refused to go through with this operation. Midland Bank then was the biggest bank in the world. He thought his bank might fail if he did something, so he didn't do it. That kept back, the fear of failure kept banks in line, and banks plainly have to be allowed to fail. Regulation does not promote banking stability. We could also point to the statistics that the United States was at one time the most regulated banking system in the world. I could say it any year in my course to my students, for the past 30 years, more banks have failed in the United States in the past year than failed in Britain in the past century. That was another statistic we quote: regulation does not prevent bank failure. Deregulation will not cause banks to become unstable, provided that the banks think they will suffer the consequences of failure. That's what we need to be focusing on to preserve banking stability. Coming now to competition and credit control. The relaxation this produced in banking did produce an enormous expansion of the money supply. But if we read the history of the time, Tim has alluded to the history, if we read the history of the time, we found this came about because there was tremendous reluctance to raise interest rates. Reluctance not so much on the part of the central bank, but rather reluctance on the part of governments to allow interest rates. So when monetary expansion was occurring, the central bank at that time did worry about that. They seem to have forgotten some things since then, but they did worry about that, and politicians resisted interest rates rises, so money growth got out of control. We have to think changes in regulation affect bank behaviour. Changes in bank behaviour may require policy responses from central banks and politicians. The banking system is, after all, a system. That's what we call it, a system, and the central bank is an integral part of the banking system, which is why we're going to study it on this course.
Well, thank you both so much. If I can change the
Juan, can I just?
Sure. Yeah.
I wanted just to some of these, a lot of myths about banks and banking, and I wanted just to pick up on this whole question about the American banks. I mean, Geoffrey's right that there are thousands of banks in America, okay, and most years some fail. But don't get too hysterical about all this, okay? And I think one of the problems of what went wrong in 2008 and 2009 is that there was a tendency to exaggerate the problems in banking. And then there was this drastic change in regulation which caused the collapse in credit, caused the destruction of money, caused the severity of the Great Recession. And in fact, I've just been involved in a debate with James Ferguson,
Yep.
you know about this. The IMF estimated in early 2009 that the American banking system was going to suffer losses of $1.6 trillion, $1,600 billion, okay? Now the capital of the American banking system at that time was less than this figure. It was less than $1,600 billion, and therefore, according to the IMF, the American banking system was bust. And that was why it needed lots more capital, according to the IMF and other top officials, central bankers around the world. This is now in the past. We have some figures of the actual profitability and losses of the American banking system in this it was a very difficult period. Let's be clear about that. I'm not disputing that. But the actual figures for write-offs of loans and leases in the period up to 2011 was 2007, $38 billion, 2008, $89 billion, 2009, $175 billion, 2010, $176 billion, 2011, $105 billion, and then it starts to fall. Now you add that lot up, and it's not $1,600 billion. And by the way, in this period, the banks were also making profits from their mainstream businesses. You know, they charge interest on their loans. The interest on their loans exceeds the interest paid on deposits. So in fact, in 2009, They had a loss. The only loss they had, and it was $12 billion. That was their loss, not $1,600 billion. American banks weren't bust in 2007, 2008. That wasn't the cause of the Great Recession. The cause was this drastic tightening of bank regulation. All right? So it's very important that we, understand how banks work, understand the meaning of these numbers, and then we draw the right policy conclusions.
Well, thank you.
If
Actually,
I can develop that one, it's also very important to distinguish clearly what we mean by the banking system. This too was brought home to me really. We often confuse these matters by the book I reviewed on competition and stability in banking. Because we think about competition conventionally by numbers of firms in the industry. That's what economists tend to do. That's what the competition authorities tend to do. That is a fundamentally misleading way to think about competition. Alfred Marshall, the great Victorian economist, emphasized, and quite correctly, freedom of entry and freedom of exit. If you can have free entry and free exit, then the firms are competitive. If they're not efficient, they will be driven out of business and will fail. Other firms can enter, and the system as a whole is preserved. What matters is the system as a whole, not the individual components of it. So many individual banks can fail and should be allowed to fail, provided there is freedom of entry and freedom of exit. The present policies we have inhibit these things, and thus in turn makes our banking system significantly less efficient, as well as significantly less robust.
well, yeah, may I just say that that's something we should be focusing much more on, the contestability of the market, if I may say, Geoffrey, and a sort of a dynamic approach to competition rather than snapshot on how competition is at the minute. So like a long-term approach to competition, much more dynamic and based on contestability, as you said. And going
But
back,
I actually didn't say contestability. That was a modern term invented.
I know.
People rediscovered Alfred Marshall.
yeah, I know I'm saying it because we have some students from the University of Buckingham, and we use that concept in the regarding the regulation of public utilities. That's why I did.
If you rediscover the wheel, I still think it's called the wheel.
Okay. All right. Thank you. And talking about Tim's comments on the crisis, actually, this is one of the things we are going to put our emphasis on the masters, on the relationship between bank regulation and monetary aggregates, how they change, how they are affected by bank regulation, and the macroeconomic outputs. This is indeed very important. And indeed, this is at the core of the research agenda of the Institute of International Monetary